Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Here on the Deep Dive, our mission, as always, is to take a stack of your sources and extract the most important nuggets of knowledge, giving you a shortcut to being truly well-informed. We really aim for those aha moments, making complex topics clear and hopefully keeping you hooked along the way. Today's deep dive, it's built from a really fascinating collection of recent financial news. We're looking at Wednesday, July 9th and Thursday, July 10th, 2025. Our insights are drawn from top-tier sources like Yahoo Finance, CNBC, Reuters, CNN, and Bloomberg. And our conversation today is going to explore that intricate dance between global economic policies, the relentless march of tech innovation, and some significant corporate moves shaping the markets. Okay, so let's start by unpacking this. There's a lot of significant movement and chatter around the Federal Reserve, especially concerning Chairman Jerome Powell's future and, well, the whole direction of monetary policy. What are the real stakes here? What pressures is the Fed facing?
Well, what's really striking here, and Yahoo Finance highlighted this on Wednesday, is the strong signal from Deputy Treasury Secretary Michael Faulkner. He explicitly stated he would hope Powell steps down from the Fed Board of Governors after his term as chair ends next May. And he cited tradition.
Right, tradition. It's not just a casual comment then. It points to this expectation that Fed chairs step down once the chairmanship is over.
Exactly. And the administration seems pretty keen to fill those seats. You've got a new 14-year Fed board seat opening up when Governor Adriana Kugler leaves on January 31st. And clearly, they're hoping for a second seat if Powell does make that exit.
And Yahoo Finance mentioned Trump's search for a successor is already active.
Oh, yeah. Candidates are already out there publicly criticizing the central bank. You've got names like Kevin Hassett, the NEC director, Treasury Secretary Scott Bessent, and former Fed Governor Kevin Warsh being floated. Warsh was on Fox Business talking about bad economic policies, and Bessent apparently has a string of criticisms.
So this isn't just musical chairs. It sounds like a potential shift in the Fed's whole philosophy.
It certainly seems that way. And Faulkner, in that same Yahoo Finance interview, he didn't mince words. He argued there's a strong case for the Fed to ease monetary policy, to lower interest rates. He actually said, quote, "One is hard-pressed to look at the data and come to the conclusion that we are in an environment where inflation is a significant challenge to the American worker."
Okay, so that's a pretty clear push for rate cuts coming from the Treasury.
Absolutely.
But then you look inside the Fed itself and it's not quite singing from the same hymn sheet, is it?
Not at all.
Well,
The minutes from their June meeting, which came out Wednesday, they showed most members thought lowering rates sometime this year would be appropriate. They even noted that inflation pressure from tariffs might be, temporary or modest.
that there's a catch.
Pretty big one. The minutes also revealed only a couple officials were open to cutting rates as soon as the next meeting, July 28-29, while some actually believed no rate cuts would be appropriate this year at all.
Why no cuts?
They cited that seems to be part of the justification, yes. And Brazil's response. President Lula said Brazil will respond with reciprocity, citing their own laws. And that 50% rate, it's the largest duty the White House has imposed in this recent round. Considering Brazil ran a $6.8 billion trade deficit with the U.S. last year, this could really bite.
Okay, and beyond Brazil, there's copper, also a 50% tariff, effective August 1st.
That's right. Both CNBC and CNN reported on this. The justification given was a robust national security assessment.
National security, how so?
Well, Trump, apparently via Truth Social, listed all sorts of critical uses: semiconductors, aircraft, ships, ammunition, data centers, batteries, radar, missile defense,
Yeah.
even hypersonic weapons.
Okay.
He also noted it's the second most used material by the Department of Defense.
And the market reaction, copper prices.
Immediate and dramatic. CNBC reported U.S. copper prices spiked over 13% on Tuesday. That's the best one-day gain since 1989.
Wow.
And then it rose another 2.6% on Wednesday.
So what does that mean for the price difference between U.S. copper and global copper?
It's created this unusually wide premium. Forecasts suggest U.S. consumers could end up paying around $15,000 per metric ton, while the rest of the world pays closer to $10,000 by August.
That's a huge gap. It raises a big question, though.
Hmm.
Can the U.S. even meet its own copper demand with these tariffs?
That's the critical point. The U.S. imports nearly half its copper, mostly from Chile. Experts like former Commerce Secretary Carlos Miguel Gutierrez, quoted by CNBC, warned that while reliance is a vulnerability, the U.S. just doesn't have the capacity right now to offset imports.
And building that capacity takes time.
Decades, potentially, according to Gutierrez. Meanwhile, China's foreign ministry weighed in, saying they oppose generalizing national security concepts and believe there are no winners in a trade war.
Okay, so tariffs, trade friction. You'd expect markets to be nervous, but what actually happened?
This is the really interesting part. U.S. stocks actually rose on Wednesday. The Nasdaq Composite hit a new record high.
Seriously?
Yeah. According to CNBC, investors seem to just shrug off the latest tariff developments. Their focus shifted elsewhere.
And where did that focus shift? Don't tell me. AI.
Bingo. Straight to the burgeoning world of artificial intelligence, where NVIDIA just did something truly historic.
Okay, this I want to hear about. NVIDIA solidifying its role as the AI driving force.
Absolutely. Yahoo Finance and CNBC reported this big news. NVIDIA became the first publicly traded company ever to briefly hit a $4 trillion market capitalization.
$4 trillion.
During trading on Wednesday, July 9th, it closed slightly below that, but still remained the world's most valuable company, leapfrogging Microsoft and Apple.
And the growth trajectory is just insane.
Completely. It hit $2 trillion just in February last year, $3 trillion only 4 months later. And the stock is up 42% in just the last 3 months.
Wow. I saw Jim Cramer on CNBC was talking about this.
He was. He made the point that neither Microsoft nor Apple can claim they're creating a new industrial revolution right now, quite like NVIDIA can. He sees their tech enabling everything, humanoid robots, self-driving cars. He even suggested any computer with a GPU less powerful than NVIDIA's is basically obsolete.
A GPU being the graphics processing unit repurposed for AI.
Exactly. And Cramer also highlighted NVIDIA's strategic value to the U.S., calling it the only bargaining chip with China because of the sheer demand for their products.
And this isn't just hype, is it? Their core business is central.
No, it's fundamental. As Yahoo Finance noted, their chips, those modified graphics cards, and their CUDA software platform.
CUDA being their special software framework.
Right. It makes their hardware incredibly efficient for those complex AI tasks. They're critical for both training and running AI programs. And the tech giants, Amazon, Google, Meta, Microsoft, Tesla, they're spending reportedly hundreds of billions on NVIDIA hardware.
Which brings up a practical problem. All that computing power generates a massive amount of heat, right? You need serious cooling.
You absolutely do. It requires huge amounts of energy and specialized cooling, and that's driving innovation in maybe unexpected places.
Like Amazon Web Services.
Precisely. CNBC reported that AWS has actually developed its own hardware to cool these next-gen NVIDIA GPUs. They call it the In-Row Heat Exchanger, or IRHX.
In-house cooling, why not just buy something off the shelf?
Well, AWS apparently looked at third-party liquid cooling systems, but found they'd take up too much floor space or use too much water and couldn't scale effectively for their needs.
So they built their own. Smart.
Very smart. It can be plugged into existing and new data centers. Developing it in-house means less reliance on third-party suppliers. And that control over infrastructure actually helped AWS achieve its widest operating margin since at least 2014, contributing most of Amazon's net income.
Strategic. And speaking of Amazon's AI strategy, Reuters reported they're deepening their investment in Anthropic.
Yes, another multi-billion-dollar investment is apparently being considered to strengthen that strategic partnership.
They already put in quite a bit last year, didn't they?
They did. $8 billion committed back in November. This new investment would help Amazon keep its position as one of Anthropic's biggest shareholders, ahead of Google, which has put in over $3 billion itself.
So Amazon's really working to boost its AI profile, competing with OpenAI and Google.
Exactly. It just shows the intense competition and the huge capital needed to play at the top level in AI right now.
Okay, let's shift gears again. Let's turn our attention across the pond to some corporate drama. It really shows the power activist investors can wield. Johnson Matthey.
That's the one. CNBC reported on this. Standard Investments, an activist investor based in New York, basically forced major changes at London-listed Johnson Matthey. After a 6-month public pressure campaign, Standard halved its stake, dropping from about 9.5% down to 4.75%.
What was their complaint?
They started agitating late last year, accusing the board of sustained underperformance that had wiped out shareholder value. They specifically called out the chairman, noting investors lost 53% during his 6-year tenure. They weren't subtle about it.
And did the pressure work?
Oh, absolutely. It prompted a significant overhaul at Johnson Matthey. January, new board investment committee formed, investment in their hydrogen technologies business halted. February, Chairman Patrick Thomas, the one singled out, announced he'd leave in July, then the big one in May. They agreed to sell their Catalyst Technologies business to Honeywell for $1.8 billion.
And that price was good.
CNBC noted it was far above market expectations. Investors loved it. The shares surged 30% after the announcement. Analysts called it a surprise value unlock.
So Standard Investments cashed in on the rally they helped create.
Pretty much. They sold as the share price recovered to over £18, up more than 35% from its low when the campaign started back in December. It really shows what focused activism can achieve.
A clear win for the activists there. Now, sometimes corporate strategy changes aren't forced by activists, but driven by broader market trends like consolidation. Like what might be happening with Ferrero and Kellogg.
Right. Bloomberg and CNBC reported that Ferrero International, Nutella, Bueno, is apparently nearing a deal to buy WK Kellogg Co.
WK Kellogg, that's the cereal side. Fruit Loops, Frosted Flakes.
That's them. The deal is valued at about $3 billion.
And for Ferrero, this is part of a bigger strategy.
Definitely. It cements their push to expand their sort of comfort food empire and build their presence in North America. They previously bought Fannie Mae Chocolates and Nestle's U.S. candy business.
And for WK Kellogg, they've been struggling a bit since the split from the main Kellogg company, right?
They have. CEO Gary Pilnick mentioned a challenging operating environment. Consumers moving away from sugary cereals, opting for cheaper private labels. So this deal could be a real boost for them.
And the market reaction.
Very positive. WK Kellogg shares surged as much as 54% in post-market trading after the news broke. Clearly, investors see potential value there.
Okay, let's pivot now to emerging markets. India's financial landscape is seeing this massive boom in derivatives, but there's a downside.
A very significant downside. The scale itself is staggering, as highlighted in CNBC's Inside India newsletter. India now accounts for nearly 60% of global equity derivatives volumes.
60%. Just remind us, what are derivatives again in this context?
Right. So these are financial contracts, like futures and options, whose value comes from an underlying asset, like a stock or an index. You're essentially betting on the future price movement.
And millions of people are trading these in India.
Nearly 11 million individuals in the last financial year. But here's the kicker. India's market regulator, SEBI, did a study and found that over 90% of retail futures and options traders lost money last year.
90% lost money. That's huge.
It is. And the total losses hit 1.06 trillion rupees. That's roughly 12.5 billion US dollars. And that loss figure was up 41% from the previous year.
Good grief. Who are these traders? Are they experienced investors?
Not typically. Reuters, cited by CNBC, painted a picture. More than 40% were under 30. Over three-quarters earned less than $6,000 a year. Many are first-timers, drawn in by promises of quick profits, often amplified on social media, places like Telegram channels.
So they're maybe chasing hype, using mobile apps, mimicking strategies without fully understanding the risks. FOMO.
Exactly. Fear of missing out is a big driver. And these are highly leveraged, risky trades. They have limited income buffers. The rise of weekly expiries makes it even riskier. They're cheaper, sure, but the short time frame amplifies potential losses dramatically.
As the regulator stepped in?
Yes. SEBI recently barred a global trading firm, Jane Street, accusing them of manipulation, though Jane Street denies it, saying it was just basic arbitrage trading. SEBI is also looking at potentially banning weekly expiries on individual stocks and has mandated better risk disclosures.
It's a real balancing act, isn't it? Encouraging financial participation versus protecting inexperienced investors from massive losses.
It's a classic challenge. Innovation versus investor protection. A cautionary tale playing out on a massive scale in India.
Okay, let's get a quick pulse check on the broader global markets. How did Asia-Pacific trade on Thursday?
Generally mixed, according to CNBC.
Any highlights?
Singapore stocks hit another record high. Actually, their fourth consecutive day. South Korea's central bank held its policy rate steady at 2.5%, which is an almost three-year low, despite their economy contracting in Q1.
And the other major indices?
Japan's Nikkei 225 slipped a bit, about 0.44%. South Korea's Kospi added a solid 1.58%. Australia's S&P/ASX 200 slid about 0.59%, while mainland China's CSI 300 edged up almost 0.5%.
And I saw something about Vietnam.
Yes, JP Morgan upgraded Vietnam stocks to overweight within the ASEAN region. They cited the country's trade deal with the U.S., a 20% tariff rate, which is favorable compared to others, and strong Q2 GDP growth nearing 8%.
Interesting. Okay, and before we wrap, a quick look at crypto. Bitcoin hit a new peak.
It did indeed. CNBC reported Bitcoin topped $112,000 on Wednesday afternoon.
A new all-time high.
Yep, reached $112,052.24, just edging past its previous record from May 22nd.
What drove that surge?
It came on a day investors generally shifted back into risk-on mode. You saw the tech-heavy NASDAQ also hitting a record close. The Bitcoin rally seemed helped by an NVIDIA-led rally in equities, as CNBC put it. And again, investors appeared to shrug off those tariff concerns we talked about earlier.
So positive sentiment in tech and AI spilling over.
Seems like it. And the outlook suggests potential for more records in the second half of the year. Factors mentioned include corporate treasuries accelerating their Bitcoin buying, and maybe even new crypto legislation coming out of Congress.
Right. Okay, so we've covered a lot today. We've navigated a pretty complex landscape, from the politics of central banking and trade wars to groundbreaking AI advancements and those dynamic shifts in corporate strategy. This deep dive, I think, really shows how seemingly separate headlines are often deeply interconnected, hopefully giving you a clearer, more nuanced view of today's financial world.
Absolutely. And this deep dive has really uncovered a fascinating interplay between, political pressure, these massive tech breakthroughs, and shifting market dynamics. So maybe a final thought for you, the listener, to ponder. As you reflect on today's discussion, considering this blend of political maneuvering, rapid technological innovation, and evolving consumer behavior we've discussed, how might the resilience of global supply chains and economic models be truly tested? What stands out to you as the most significant ripple effect from today's deep dive?
Something to think about. Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.